Picture this. You've been house hunting for 4 months. You found the one. 3 bedrooms, good neighborhood, backyard your kids can actually use. You put in the offer, they accept it. You've already told your mom. You've already measured the living room in your head. And then your loan officer calls you 2 days before closing. I'm sorry, the bank can't fund the loan. Not a smaller loan, not a delay, a full decline, after you were pre-approved. This happens more than most people know, and almost nobody talks about why. Because the bank isn't going to explain it clearly. Your real estate agent doesn't always know the details, and by the time it happens, you've already paid for inspections, appraisals, and taken time off work. The damage is real. The embarrassment is real. And here's the part that stings the most. It was preventable, almost every single time. Pre-approval feels like a finish line. It isn't. It's actually the starting line. And there's a gap between that starting line and the closing table that can swallow your entire deal whole if you don't know what lives inside it. That gap is what we're walking through today. Not theory, not general advice, the exact things that kill deals after pre-approval. And more importantly, what you do before, during, and after to make sure you're not the person getting that phone call 2 days before closing. My name is Ricky, and I spend way too much time thinking about how regular people get tripped up by financial systems that were never explained to them. I've watched this happen to people who did everything right by their own understanding. Good income, good credit, responsible people, and they still got the call. I'm going to show you exactly why that happens and exactly how to stop it. If this kind of real, practical content helps you out, hit that subscribe button and give it a thumbs up. It genuinely helps other people find this who need it. All right, let's get into it. Here's the thing most people get completely wrong. Pre-approval is not a promise. Read that again. Pre-approval is not a promise. It's a conditional opinion. The bank is saying, based on what we see right now at this moment, with the information you've given us, you look like someone we'd probably lend to. Probably. That word is doing a lot of work in that sentence. Think of it like this. Imagine you applied for a job. You passed the phone screen. The recruiter said, "Things look great. We'd love to bring you in." Does that mean you have the job? No. It means you passed one filter. There's still the interview, the background check, the reference calls, the hiring manager's final decision. Pre-approval is the phone screen. Closing is the job offer. And a lot can change between those two moments. Now, here's where it gets psychological. When we want something badly enough, our brain starts treating possibilities like certainties. You got pre-approved and your brain immediately started decorating the house. That's not a character flaw. That's just how human beings work. But the mortgage process doesn't care about your emotions. It runs on documentation, ratios, and a second review that most people don't even know is happening. That second review has a name. It's called underwriting. And underwriting is where pre-approvals go to die. Here's what most people don't realize. When you got pre-approved, a loan officer looked at your file, checked your credit score, your income, your debt, ran some numbers. Quick process, maybe a few hours. But when you're under contract on an actual home, your file goes somewhere else entirely. It goes to an underwriter. An underwriter is not a loan officer. An underwriter is a risk analyst. And here's the critical difference. Your loan officer's job is to help you get the loan. The underwriter's job is to find reasons it shouldn't be approved. Not reasons it should, reasons it shouldn't. And they go deep. 2 years of tax returns, bank statements line by line, every employer you've had, the property's full history, the appraisal, the title, things your loan officer never asked about. 3 things matter most in that deep review: your income stability, your debt load, and the property itself. If anything in those 3 areas shifted since the day you got pre-approved, and I mean anything, the underwriter will find it. That's the reframe. Pre-approval got you in the room. Underwriting decides if you leave with the keys. Now let's talk about exactly what kills deals inside that room. Let me ask you something. You've been working the same job for 3 years. You've been responsible. You've been planning this purchase for months. And then, right in the middle of your contract period, a better opportunity shows up. More money, better title, same industry. You take it. Makes total sense, right? It just killed your mortgage. Here's why. Lenders don't just care about how much you make, they care about stability. Specifically, they care about what's called employment continuity. When you change jobs mid-transaction, even for a raise, the clock resets. If you're moving from salary to hourly, they may need 30 days of new pay stubs before they'll count that income. If you're moving from employee to self-employed, they may need 2 full years of tax returns from that new business before they'll count it at all. And if closing is in 3 weeks, there's nothing to show them. The math here is brutal. Say your pre-approval was based on a $75,000 salary. You switch to a new role that pays $85,000, but it's commission-based. The lender cannot count that commission income until you've earned it consistently for 24 months. So, they qualify you on base salary. Maybe that's $45,000. Your debt-to-income ratio just blew past their limit. Deal dead. The rule is simple. Do not change jobs between pre-approval and closing. Not for more money, not for a better title, not for anything. Wait until you have keys in your hand. 2 weeks of patience can save 4 months of work. Most people think your credit score is what matters for the mortgage. It does matter, but there's a second number that matters just as much during this window. It's called your debt-to-income ratio, DTI. And this number is more fragile than your credit score during a home purchase. Here's how it works. Your DTI is your total monthly debt payments divided by your gross monthly income. Most conventional loans want that number below 43%. Some want it below 36%. When you got pre-approved, your DTI was fine. But then you did something completely normal. You bought a car because your old one was making that noise, or you financed furniture for the new place, or you opened a store card to get that 10% off. That car payment is $480 a month. Doesn't sound like much, but on a $60,000 income, that one payment can push your DTI from 41% to 47%. You just crossed the lender's limit, and they find out because they pull your credit again. Let me say that clearly. The lender pulls your credit at the beginning of the process, and they pull it again right before closing. If anything new shows up on that second pull, new accounts, new balances, new inquiries, they will ask about it. And if it changes your DTI, it changes your approval. The rule is this: from pre-approval to closing, your credit profile is frozen. No new credit cards, no car loans, no financing anything, no co-signing for anyone. Not until after closing, not even close to closing. This one surprises people every single time. You've been saving, working hard. Maybe family wants to help out. Your brother sends you $5,000 toward the down payment. Your grandmother gives you $3,000 as a gift. You deposit it. It's sitting in your account. It's your money now. Problem: lenders have to verify where every large deposit in your account came from. Not because they think you're dishonest, because of federal lending rules designed to prevent undisclosed loans. If you have a large deposit they can't source, they may not be able to count that money toward your down payment or reserves. And if you don't have enough verified funds at closing, the loan doesn't close. The technical terms here are sourcing and seasoning. Sourcing means explaining where the money came from. Seasoning means how long it's been sitting in your account. Money that's been in your account for 60 days or more is generally considered seasoned. Money that showed up last Tuesday from your cousin is not. If family wants to help you, there's a right way to do it. It's called a gift letter. The person giving you money signs a document stating it's a gift, not a loan, and they're not expecting repayment. Your lender has a specific form for this. Use it. Do it early, not the week before closing. The rule is this: any money coming into your accounts during the transaction needs a paper trail. If you can't explain it to your loan officer, the underwriter can't approve it. Okay, stop for a second. I want to be real with you before we go into this one. Rules 1, 2, and 3 are all about things you did or didn't do. This rule is different. This one can hit you even when you've done everything right. And I want to tell you about someone it happened to. because when I describe it, I don't want you to think I'm exaggerating. A couple found a home listed at $318,000. It was move-in ready, updated kitchen, new roof, great neighborhood. They were pre-approved at $340,000. More than enough room. Offer accepted, inspections done, everything looked clean. And then the appraisal came back. $291,000. Not $318,000. Not close to $318,000. $291,000. The lender would only loan based on that appraised number. So now this couple had three options: renegotiate with the seller and hope they'd drop the price by $27,000, come up with an extra $27,000 in cash to cover the gap at closing, or walk away and lose the inspection and appraisal fees they'd already paid. They couldn't renegotiate. The seller refused. They didn't have an extra $27,000 sitting around. They walked away. 4 months of searching, gone. Here's what I want you to understand about that story. Their finances were fine. Their credit was fine. Their pre-approval was fine. The property failed them. And here's the part nobody tells buyers up front. Your pre-approval is about you. The loan is about you and the property. Both have to pass. So how do you protect yourself from this? Because here's the thing. You actually have more tools than you think. Before you ever make an offer, look at recent comparable sales in that neighborhood. Not the listing price of other homes, the sold price. Most real estate apps show you recent sales. Use them. If similar homes in that area have been selling for $280,000 to $295,000, and this one is listed at $318,000, there's your warning sign. The seller may be priced too high for what appraisers are seeing in the market. Second thing, ask your real estate agent directly. Based on recent comps, do you think this home will appraise at the asking price? A good agent will give you a straight answer. If they hedge a lot, push them. You need to know this before you spend money on an inspection and appraisal, not after. Third thing, include an appraisal contingency in your offer. This is a clause that says if the home appraises below the purchase price, you have the option to renegotiate or walk away without losing your earnest money. In a hot market, some buyers waive this to make their offer more competitive. That's a real risk. Understand what you're giving up if you do. And fourth, understand what loan type you're using. FHA and VA loans have property condition requirements that go beyond just value. The appraiser on those loans is also checking whether the home meets minimum property standards. Peeling paint on older homes can trigger a condition. A water heater without a proper pressure relief valve can trigger a condition. Missing handrails on stairs can trigger a condition. These aren't deal killers automatically, but they require repairs before the loan funds. And if the seller won't make them, you're in a difficult spot. The rule here is this: don't fall in love with a property before you understand what it's worth to the market, not just to you. Your emotional valuation and the appraiser's valuation are two completely different numbers. Find out early if they're likely to match. This last one is the quietest killer of all 5. Your income is solid, your credit is clean, your DTI is within range, the property appraised fine. On paper, everything looks right, but the underwriter keeps asking for more documents. And somewhere in that back and forth, something gets missed. Here's something most buyers don't know going in. Underwriters don't just approve loans. They approve loans with conditions. Conditions are a list of items you need to provide or clarify before the loan can actually fund. Some are simple: a letter explaining a 2-year gap in employment, proof that an old collection account was paid off, bank statements showing where a specific deposit came from. Some conditions are more complex. And here's what makes this one different from the others. Underwriters can issue new conditions at any point in the review. They can look at your file on a Tuesday thinking everything looks fine, and then on Thursday notice something that generates 3 new conditions. That's not unusual. That's just underwriting. The problem isn't the conditions themselves. The problem is response time. When a condition sits unanswered for 2 days, the clock keeps moving. Your contract has a closing date. The seller has a moving timeline. And if conditions pile up without responses, deadlines pass. Sellers get frustrated. Contracts fall through. The people who close on time share one trait consistently. They treat every document request like the deal depends on that hour. Because sometimes it does. When your loan officer asks for something, you get it that day, not tomorrow, that day. The rule is simple, but it requires discipline. Respond immediately. Ask questions if you don't understand what's being requested. And stay in communication with your loan officer throughout the entire process. Not just at the beginning, not just at the end, throughout. Now, here's what I really want you to understand. These 5 things don't usually show up alone. They stack. Think about the person who changed jobs right after getting pre-approved, already dealing with the employment continuity issue, and because they're stressed about the new job and the move, they financed a car. Now their DTI changed too. And because they needed help with the down payment, a family member wired the money last minute with no gift letter. Now the sourcing problem. 3 issues, 1 transaction. Almost 0 chance of closing on time. Here's what makes that situation so painful. Every single one of those decisions made sense in isolation. Better job opportunity? Take it. Old car breaking down? Replace it. Family wants to help? Accept it. None of those choices felt reckless. But inside a mortgage transaction, the timing of normal decisions can be catastrophic. There are 2 kinds of buyers on the other side of pre-approval. One person understood what pre-approval actually meant. They froze their finances the day they went under contract. They responded to every document request within hours. They asked their loan officer up front, "What should I absolutely not do between now and closing?" They got a list. They followed it. They closed, on time, no drama. The other person had the same income, the same credit score, the same goal, but they made normal human decisions during the process without knowing those decisions had consequences inside this specific window. Changed jobs, bought a car, accepted a wire from mom, got the call 2 days before closing. The difference between those 2 people is not financial discipline. It's not intelligence. It's not even preparation in the traditional sense. It's information. One person knew the rules of the game. The other person didn't know there were rules. That's it. That's the whole gap. Let's go back to where we started. You found the house. They accepted the offer. You've already told your mom. Here's what happens differently this time. You call your loan officer that same day and you ask them 2 questions. First question, what should I absolutely not do between now and closing? Write down everything they say. Second question, what documents are you going to need from me and when do you need them? Get that list in writing too. From that point forward, your finances are frozen. No new credit, no new financing, no large unexplained deposits. If anything changes with your employment, you tell your loan officer before you signed anything, not after, before. When documents are requested, you respond the same day, not when you get around to it, the same day. And before you fall in love with a property, you do a quick check on comparable sales. You ask your agent directly whether they think it will appraise at the asking price. You make sure your offer includes an appraisal contingency unless you fully understand the risk of waiving it. Here's what I want to leave you with. Closing on a home is not about having perfect finances. Most people who close successfully don't have perfect finances. They have a clean, consistent, explainable financial picture. That's what underwriters are actually looking for. Not perfection, consistency. Let that sit for a second, because if you've been worried that your finances aren't strong enough, that might not even be the real risk. The real risk is a change. One job switch, one new loan, one unexplained deposit. Not a weakness, a change. That's what derails deals. So when somebody asks you why pre-approval doesn't guarantee anything, you'll know the exact answer. It's not personal, it's not random, it's not bad luck. It's a system with specific rules that nobody explained to you. Until now. The starting line was the day you got pre-approved. The finish line is the day you get the keys. Now, you know what's in between. Go close. If this helped you, hit that subscribe button and leave me a comment below. If you're in the middle of a home purchase right now, tell me where you are in the process. I read every single one.